JohnCBogle, The Little Book of Common Sense Investing, the only way to guarantee your fair share of stock market returns. In the book, The Little Book of Common Sense Investing, by JohnCBogle, the author provides valuable insights into the complex world of investing and offers advice on how to make the most of your hard-earned money. This summary focuses on the pitfalls of actively managed funds, the superiority of low-cost index funds, and the importance of prudent decision-making when it comes to investments. Discover the reasons why most actively managed funds fail to deliver satisfactory returns and unveil the secrets to guaranteeing your fair share of the stock market returns through a sensible and cost-effective investment strategy.
The pitfalls of actively managed funds. Actively managed funds are not as profitable as passive index funds due to high fees and unsustainable speculation. If you've ever invested in the stock market, you know that it can be challenging to gauge the worth of a stock. To mitigate these risks, some investors opt for actively managed funds. With these funds, a specialized manager evaluates the stock portfolio regularly and makes changes according to market trends. However, actively managed funds are risky, primarily because of their high costs. Investors must pay brokerage commissions and fund manager fees, leading to significant reductions in profits. Despite the potential for high returns, these funds can yield less profit than passive index funds when calculated over longer periods. Speculation on stock prices is not a sustainable strategy, and even if a fund generates significant profits by buying and selling based on market trends, it cannot outperform the overall development of the stock market. The high costs of actively managed funds make them significantly less profitable than passive, low-cost index funds. In fact, if you invested $10,000 in 1980 and chose an active fund rather than an index fund, you would have 70% less in returns by 2005 due to fees alone. Ultimately, investors need to consider the potential risks and costs of actively managed funds. Active fund investment, a costly bet. Despite the high fees that investors pay the financial experts, actively managed funds do not perform well compared to the overall stock market. The book provides facts to back this up, stating that most funds go bankrupt or fail to bring significant returns. Only 24 out of 355 funds have consistently outperformed the market and remained in business. Even profitable funds cannot guarantee good performance in the future. Investing in funds with a good track record is not a sure bet either, as past conditions may not repeat themselves, and changes in fund management and investment opportunities can significantly affect their performance. Thus, paying for financial expertise in actively managed funds could be a waste of money, considering the low success rate and inherent market volatility. Investors are advised to consider alternative investment options that align with their risk tolerance and investment goals rather than flocking to actively managed funds. The hidden truth behind actively managed funds. Actively managed funds come with high costs that investors often underestimate. Fund managers usually boast about high returns but leave out the actual fees that will be deducted. In contrast, investors tend to make unsound investments because they let popular opinion sway their decisions. This is why people pour money into actively managed funds because everyone else is doing the same thing. However, investing money in alternative avenues is crucial to ensure wise investments. Why index funds are a smarter choice. Index funds provide a cost-efficient and low-risk alternative to actively managed funds, offering commercial net returns and long-term benefits. By holding a diversified portfolio that reflects the market indefinitely, index funds offer returns at the real value of stocks while minimizing operating costs. As passive funds, they track the performance of all stocks included in the index without betting on individual stocks. This means you don't have to bear operating fees or fund management costs. Moreover, index funds are likely to outperform actively managed funds in the long run as the rises and falls of the stock market eventually level out at the real value of the stock. When compared to actively managed funds, index funds are a healthier option for long-term investment, eliminating the risks of short-term, volatile bets. This summary ends with an assurance that the next part will guide you in choosing the right index fund. Choose wisely for long-term investments. Management fees and operating expenses of index funds can accumulate over time, making it crucial to opt for the lowest cost option. While expenses are typically less than 1%, they can add up over decades. Since index funds follow the overall market, cost structure is critical, and a company's expense ratio isn't linked with its performance level. For example, the Fidelity Spartan Index Fund's annual expense ratio is just 0.007%, while JP Morgan's is 0.53%. Investment fads, buyer beware. When deciding where to invest your money, be wary of the latest investment trends. The competition between index funds has resulted in a constant cycle of new trends, with 578 of them in existence today. Established funds compete by reducing costs to attract investors, while new funds promise higher returns through new stock-picking methods but charge more. However, it is challenging to determine which stocks are undervalued or overvalued. The new Copernicans are an example of a movement that chooses stocks based on factors such as profits and dividends rather than conventional methods. It's best to stick to funds that hold a typical portfolio to avoid pitfalls. When it comes to investing, don't try to predict which fad will succeed. Instead, prioritize low costs to maximize returns.
The key takeaway from The Little Book of Common Sense Investing is the importance of considering alternative investment strategies, specifically focusing on passive, low-cost index funds. These funds are more cost-efficient and tend to outperform actively managed funds in the long run. It is crucial to prioritize low costs when choosing an index fund, as seemingly insignificant differences in expense ratios can significantly impact returns over time. The author also advises skepticism when it comes to new investment trends and stresses the need for due diligence, rather than succumbing to popular hype. Ultimately, the book encourages informed decision-making in order to make the most of your investments and secure your financial future.